My name is Anthony Siccaro. I'm founder and president of Providence Financial and Insurance Services. The reason I became an income specialist is because most advisors specialize in growth. My definition of a successful retirement is as much income as you need until the day you die.
Meet your financial advisor, Anthony Siccaro.
With years of financial experience, Anthony helps build sustainable income while protecting your assets, guiding you to financial security.
Anthony is also an attorney, helping thousands of families with estate planning, as well as a published Amazon best-selling author.
He also hosts the Providence Financial Retirement Show that airs Saturdays from 6 to 7 a.m. and Sundays from 7 to 8 a.m. on KNX 1070 News Radio.
You're going to learn today why the 4% rule, why taxes in retirement, the idea that you can adjust later, and the belief that the markets always come back deserve a closer look.
Anthony is also regularly featured on major news networks to provide his insights.
We know that inflation has ticked up recently over time, which is not good for the Feds, and it's put the Feds in a position to where they don't really know what to do.
What the PPI showed us, though, is that the wholesale costs are rising, and I think there's probably two reasons for this. Probably one, because of tariffs. That's starting to get passed through. But the second is because of labor inflation.
If you're still heading towards retirement, you're still 20 years away from retirement, I don't think you make a lot of change. I think you can even go more tech heavy, and I think in 20 years you'd be glad that you did that.
We're trying to educate you and help you learn what you need to know so that you can have the confidence and clarity in retirement that you deserve. Most retirees are concerned about something. Some have questions about Social Security. When do I take it? Some have questions about the taxation. We got all their money in IRAs or 401ks. And through education at Providence Financial, we help them answer those questions and give them a plan so that they don't have to wonder whether or not they're going to be okay in retirement. At Providence Financial, we'll help you develop an income strategy so that you know you have a secure future.
Providence Financial and Insurance Services, where your money meets purpose.
Well, good evening and welcome to our Q1 Quarterly Friends and Family webinar Q&A session where I get to take a chance and chat with you, answer some questions that you guys have previously submitted. And I'm really looking forward to spending our time together. So this is something that we try to do on a quarterly basis just to connect. Also a good way for you to refer your friends and family to us. And we had our first Providence Premier Club event just recently. It was so much fun. We'll come back to that in a little bit later. But I want to spend whatever time we need, maybe 45 minutes or so. I'm kind of guessing maybe an hour. We won't go over an hour for sure, but answering your questions. And we got a lot of questions. We got questions about the war. We've got questions about inflation. We've got a question about Roth IRA conversions. We have a question about locking in a 10% return. That's an interesting question. And we got a question about some dividend stocks. And a lot of the questions that we got a lot of questions. A lot of the questions were the same. So if you don't hear your question exactly, it might be that I kind of consolidated it into another question, but we're going to try and get to it. And every now and then we get some wacky questions that are, kind of not necessarily appropriate for here, much more personal, tons of detail in there. So there's a few that I eliminated. So if you don't hear your question, then I apologize. And, we can always speak one-on-one. But before I get to the specific questions that I have on the sheet in front of me so I can remember, before I get there, I want to answer a question that for the last couple of years, we've kind of just gotten as a whole. And just remind you of something that if you listen to me on my radio show or my podcast, or you've been to other quarterly webinars like this, or you went to our client appreciation event, many places I talk about what I'm going to just remind you of now. So nothing new in the school, but just a reminder. And the question that we often get is something along the lines of, Anthony, stock market's done really well. And yet our accounts have kind of hovered around the same level. And, why? Should we change the investments that we have? And, I think it's a good question. I think it's a logical question, but it's also a question that I think is the wrong question. And the reason is because most of you, spent 30, 40, 50 years in the world working, growing, all about capital appreciation, all about buy low, sell high. And the only number you cared about for 40 years was the bottom line, right? You get your statement. And if the account was up, you did good. If the account was down, you didn't do good. You did bad. And it was all about the bottom line. And how you got the growth didn't matter. There was one goal for your money, and that was to grow. And over time, if you take any, 25 or 30 or 35-year period in the stock market average is 8, 9, 10%, you throw in some dividends, and that's what the average is over a long period of time. So you have this habit. This is what you've been doing for 30 or 40 years. Now you start investing for income. You start investing more conservatively. You start investing the bulk of your portfolio in stuff that is not affected by the market in fixed income investments, but you still compare it to the market. So it's not a fair comparison. And the reality is that your investments, fixed income investments, are designed to protect your principal and designed to give you income, but they're not invested in the market. So the market is an unfair comparison. That's like comparing a pickup truck to a Porsche. They're two different vehicles designed to accomplish two different things. So if fixed income is not affected by the market, what is affecting fixed income? And the biggest factor, the biggest component of fixed income, what affects fixed income, is interest rates. And fixed income is affected, the value of a fixed income portfolio, whether it's bonds or all the other things that you have in your portfolio, the value is affected by interest rates. And interestingly enough, fixed income portfolios tend to react opposite of interest rates. So if interest rates go down, fixed income portfolios go up, meaning that the value, the bottom line number is generally going to go up. If interest rates go up, the bottom line number of your fixed income portfolio is generally going to go down. So it's affected by fixed interest rates. It's not affected by the stock market. And and many of you are still comparing it to the stock market. Now, if we go back to COVID, really about 6 months or so after COVID, we had massive inflation and the Federal Reserve started raising interest rates. The Fed funds rate went from 0.25% to 5.5%. It's a massive increase, 20-fold increase in the funds rate. And as a result of that increase, a lot of fixed income portfolios came down. Well, now interest rates have started coming down. They haven't come down a lot. Right now they're at 4%, but they've come down 1.5%. And some of you have seen, matter of fact, you've seen the bounce in your portfolio. Fixed income portfolios, when depending on how you're invested, jump somewhere between 5 and 7% between January and February. So you've seen a little bounce in your portfolio, but that's because interest rates have come down. Now, what's also important to understand is that every one of you that is a client of Providence Financial focused on fixed income, that's the focus, you're in one of two situations. The first situation is you're either taking income from your portfolio, or the second situation is you're reinvesting. Now, if you're taking income from your portfolio, it doesn't matter what the value of your portfolio is, you're taking the income. And when you're living off of interest and dividends, in most of your investments, it's contractually guaranteed or promised by a large company, and you can count on the income. So if your portfolio goes up or down or fluctuates, the reality is that your income's going to stay the same. So if you're living on your income, fluctuation is just noise. It doesn't mean anything. On the other hand, though, if you're in a situation where you're not retired or you're retired, you just don't need the money and you're reinvesting your income, then what's interesting about this dynamic is because the portfolios are down a little bit, not as of the last couple of months, but over the last few years, because they're down a little bit and you've been reinvesting, you get to buy more shares for the same dollar. So if you're reinvesting, what would you rather do? Would you rather wait for the price of your investments in your portfolio, your balance goes up and the investments go up, and now you have to pay a premium for your investments because you're reinvesting the interest and dividends? Or would you rather the price of the investments go down so that when you reinvest your interest and dividends, you actually get them on sale? Well, that's what you want. That's exactly what's happening is you get them on sale because the price is down. And the best thing that could happen to you is that the prices stay depressed for a little while you're investing, because of the simple fact that you're getting them at a discount. Now, eventually, rates are going to come down more, and you'll see your portfolios go back up in value. But what tends to happen is we tend to put a fixed income portfolio on a stock market time frame. Another mistake that you could be making, the stock market, in the last week has been down 5%, up 5%, down 2%, and things happen day by day, right? You've seen it. It's been very volatile because of the war. Everything happens very quickly, and it's that sexiness, and I guess that's the wrong word for this conversation now, but it's that fear driver that drives the news. If you have a bond or a fixed income portfolio that is boring, that you put your money in, you get your 5 or 6% every year, and it keeps paying you your interest and dividends, well, that doesn't drive any news. That there's nothing to say about the fixed income portfolios. It just keeps doing what it's doing. The stock market is what drives the news. That everyone, emotionally, we're all driven by one or two primary emotions: fear or greed. And right now, it's a fearful situation. So the fact is that people are concerned. So people panic. That's what happened in COVID. People panicked, and people started selling everything. Well, if you look at that and you look at the fact that the market, the S&P 500 was up 16% last year, and for a few years before that was up more than 20% each year, and then you compare that to a fixed income portfolio, you might start thinking, well, I put my money in fixed income and it's been a month and it hasn't gone up by 5% or 10%. Well, it's a different animal. The pickup truck's not going to go as fast as the Porsche. But here's the other thing too. I was talking with someone the other day. We were just having this exact same conversation, and this person was comparing to the stock market and asking why it's not in the market. And I asked them a very simple question, and I'll ask you too: can you afford to lose 50% of your portfolio? And of course, the answer was no. We can't. Investing in hindsight is really easy, right? You can look back and invest and figure out, well, I should have done, and should have bought NVIDIA, should have bought Apple 20 years ago, 30 years ago. We can do that in hindsight, but the reality is the market is still a wild animal. And in the last couple of years, when I've done my live TV interviews, several times conversation has come up in a live interview about this feeling that some people have that the stock market is kind of like a safe haven. And I've heard that come out several times: safe haven and stock market. But those two words do not belong in the same sentence. And if you can't afford to take a 50% loss, you just can't afford to be in the market. Now, most of you have some money in the market, so it doesn't mean you don't have any money in the market. But the reality is that if you can't afford to gamble, you can't sit down at the machine. That's the bottom line. And the fear, and what I've seen happen, I've been doing this 27 years, and I saw it before 2001, the tech crash, and I saw it before 2008, where someone wants to retire and the market crashes and they can't. It just takes one crash for you not to be able to retire, or for you not to be able to stay retired, or for you not to be able to live the retirement lifestyle. Just a couple of bad years can affect the rest of your retirement. And if you can't afford to take the risk, then it doesn't matter what the market did. You just still can't afford to take the risk, because past performance is not a guarantee of future results. And that's true with the market as well. No matter what the market did, it doesn't mean that's what the market is going to do. And there are a lot of professionals, including myself, that really think that the next decade of the market is not going to look anything like the last decade. And with the wars in Iran, I don't know where the market's going to go. But what I do know is if you're invested in the market, the stock market, you're playing the crystal ball game. But if you're invested for income, you're not. And whereas the stock market reacts daily, as we've seen, right? Lots of volatility, and then monthly, and then yearly. Fixed income portfolios don't do that. Interest rates don't move like the stock market. It took about 2 years to between 2 and 3 years for the interest rates to go from 0.25% up to 5.5%. And now it's taken a year and a half for them to come down from 5.5 to 4. It's the stock market's like this, like a Richter scale all over the place. The fixed income market's like this. So when you're looking at the stock market, you're not going to have like this when you. But let me back that up again. I think I said it wrong. When you look at the fixed income market, you're not going to have like this. You can't afford to have like this. So you don't want to compare fixed income to the stock market on either front, because yes, with the stock market, you could have made a lot of money, but you could have also lost a lot of money. And if you're a client of Providence, then I know that you're in a position where you just can't afford to lose a lot of money. And there's also the heartburn factor, right? I remember I was talking with someone, a client. I actually don't remember who. Maybe you're on here, but a couple of years ago, I remember talking to a client, and the reason he became a client, he said something that was just stuck with me. It was funny. He said, it seems like every time I go on a cruise, the market gets really volatile and it ruins my vacation. And literally, that's the reason he became a client. There is a heartburn factor. There's a peace of mind and stress-free factor that you have to consider. And is it worth it? Yeah, you might make more, but in this last week, I promise you, a lot of you have had some heartburn if you have money in the market, or if you have too much money in the market, and you don't need it. You don't need it. You get your steady return. Here, mark my words, fixed income is boring. It's really, but we don't need excitement in retirement. What we need is stability. And that's what fixed income gives you. So, couple of just key components before we move on to some of the questions. You can't compare the fixed income market to the stock market. They're two different investments. And the stock market's not the major driver of fixed income. That's not to say they don't interplay off of each other, but certainly the market up and down is not the fixed driver of fixed income. The fixed driver is interest rates. And the second point that you just need to remember is the time frames are different. You can't look at a fixed income portfolio that's giving you a steady 85-6% return and put it on the stock market time frame where the market could move 2, 3, 4, 5% in a day, as we've seen. You can't do that. Two different things. And as interest rates start to come down, you'll see your fixed income portfolio start to go up. But again, the balance doesn't matter. It doesn't matter if you're living off your income, because your income is going to stay the same. And if you're reinvesting your income, then as the portfolio values start to rise over the next year or 2 or 3, it actually hurts you, because now you have to pay more for the same investments as you reinvest. So hopefully that is just a quick kind of a reminder. We get this question a lot, and so I just keep reminding you as well too. So that being said, let's jump into some questions. We have 2 questions about the war. They're similar. I'm going to read them both and answer them at the same time. So the first question is this: when things like wars or geopolitical conflicts happen around the world, how much does that really affect someone's retirement plan? The markets always seem to react, but I'm not sure how much it actually matters in the long run. Okay, that's number one. So it's a war, and how much does the reacting matter? Number 2 is, with everything going on right now in the Middle East and the war involving Iran, should retirees be worried about something? Should retirees be worried about how something like that could affect the markets or their retirement accounts? Okay, so not going to be a terribly long answer. The reality is that the wars do affect things across the board. Energy prices, right? A lot of people don't realize how much energy interplays in everything. Energy interplays in manufacturing, because it takes energy to run the plants and the manufacturers. Certainly, anything that gets shipped to you is going to be shipped on a plane or in a truck or something, and the oil prices go up, it affects the prices of gas and so on. I had to buy plane tickets. I'm leaving for Florida on Thursday, and a last minute trip that kind of popped up, and I had to buy plane tickets yesterday for a flight on Thursday. And oh my gosh, I couldn't believe how much they were, because I know how much they usually are. And a lot of it had to do with energy prices. Some of it might have had to do with last minute, but I bought tickets before last minute. But energy, so that certainly is being affected by what's going on back there, and it certainly gets passed on to us. But the reality is, does it really matter in the long run? That's this one question. Does it matter? And that is something that it depends on you invest in. And I might take that question and kind of look at it as like, it doesn't really matter. That may be hinting at the safe haven in the stock market that we had talked about, that I mentioned before, because there are people who start to think that it doesn't matter what the market does in the long run. And it depends what you mean by the long run, right? This time frame. But if we start to think that it doesn't matter, then that's where it becomes really dangerous. And that's where we tend to let our guard down. It was from 1982 to 2000, there was 18 years where, other than a blip in 87, the market went straight up. that was the pre-tech bubble crash. The market just went straight up, and I was in business at the latter half of that time before the year 2000, and I remember talking to people who seem like they have the same attitude as they kind of have now. Like, it's not a big deal if the market reacts, but it's not a big deal in the long run. And it is not a big deal until it becomes a big deal. If we go back to COVID, the market dropped 37% in 37 days. 37% in 37 days. But 6 months later, it was at record highs. That wasn't a big deal, but that was artificial because the government threw $5 trillion at it, right, to prop up the economy through all the PPP loans and the people on unemployment and everything else. It was almost a fictitious recovery. It wasn't a real recovery. It was a recovery built on false money, which has a lot to do with inflation. We've got a question about inflation later. But the reality is it does matter depending on how you're invested. If you're invested in the stock market and you're selling principal to get your income, or you're invested in the stock market, maybe you haven't started taking income yet, you're not retired yet. Well, the simple fact is that my fear is that something like this happens, maybe another war or another pandemic, which we don't, there are things going to happen, right? 2 weeks ago, we didn't know this war was going to happen. There are things that are going to happen that are going to spook the market. And at some point in time, my fear is that the market gets spooked and doesn't recover. And this has happened many, many times in history, right? From, notably the most recent, from the financial crisis, the market hit a high, record high, all-time high in 2007, and hit a low in 2009, March 9th of 2009. The market was down about 60%. 60% in a year and a half. And it took until 2014 to recover. We had 7 years drop and recover. What if that happens again? What if that happens again and you're involved in the market and you want to retire next year, you want to retire 2 years, and you get caught in that dip, you get caught in the trough? What if that happens? That's what we're trying to avoid. When you're invested in the stock market, there's that risk. When you're invested in for income, that risk goes away. It doesn't mean there won't be fluctuation. It doesn't mean that income portfolios won't fluctuate. But when you're living off interest and dividends, then you don't have to worry about what's going on in the stock market. And if you can afford to take the risk, if you're someone that says, hey, I don't care, I don't need the money, and 50% drop and a 50% recovery, and really, by the way, a 50% drop means you have to have 100% recovery. The way the math works. But if something like that over the next 6 to 9 years, wouldn't affect you, then great, you can stay invested for growth. But if something like that would affect you, would cause you not to be able to retire on schedule, or not be able to get you the income you need, or create a massive heartburn, even if that's all it was, the reality is that you shouldn't be invested in the market. Yeah, I don't want your ability to retire or stay retired or be able to sleep at night tied to what the market does. And when you're invested for income, it's boring, but it's stable and you can sleep. Oftentimes I refer to income investments as sleep insurance, because you're going to get your income, month in and month out. So, does it really affect, does it really affect? Yeah, it affects you if you're invested in the market. It doesn't affect you if you're invested for income. Okay. I think that's probably the better way to say it. So I think I answered those two questions about the war. Let's move on. Inflation. And again, I got a couple of questions about inflation. So let me just read both of them and we'll kind of answer them together. And I kind of categorize these for ease of being able to answer them. So question number one about inflation. I'm planning to retire in a couple of years, and inflation honestly worries me because it seems unpredictable. How does inflation affect how much someone should safely withdraw from their retirement accounts once they stop working? Great question. The second question is, with inflation still being higher than it used to be, how should retirees be thinking about protecting their purchasing power over the next 10 or 20 years? Seems like everyday expenses just keep going up. Great questions. Two questions about inflation. So let me give you a general thought. A question that wasn't asked here, but a question that we often get. Usually this question comes from listeners on my radio show that might have caught me for the first time, and they hear me talking about fixed income. They like what they heard. They called in. They want to have a conversation with me, but they don't know us. They don't know what we do, other than maybe what they heard, and then they called in. And the question we get from those type of people often is, well, if you're invested for fixed income, how do you keep up with inflation? And it's a great question from my point of view, being a fixed income expert. It's kind of a silly question Because over the long run, inflation is generally averaged around 3 to 4%. Okay. Now, you go back to May of 2022, and it was 9%, right? Because we had, the artificial inflation and the Federal Reserve fought it, and they brought it down. But, but then if you go back 20 years before that, it was under 2%. So it's all averages. Over the long run, generally around 3 to 4%. Now, if you're talking about fixed income, the interest rates that you can get on fixed income are generally 1 or 2% above inflation. So right now, if we invest you for fixed income today, you're going to be able to get somewhere around 5 or 6% a year after fees, 5 to 6% a year. Well, if inflation is 3% and you're getting 6%, I mean, does that sound like a good inflation adjuster? It does. But a lot of times, somehow there's something out there that people, because we get the question a lot, some people think that inflation is, if you're invested for fixed income, then you can't keep pace with inflation. Now, that being said, if you are getting 6% on your portfolio and you're spending 6% on your portfolio, now you could have a problem. Because if you're 65 years old and you're getting 6% on your portfolio and you're spending 6%, you're spending everything you make. And while you were growing up, if you spent everything you make, you wouldn't have any savings. Well, if you're spending everything you make from dividends and interest, there's no room to adjust for inflation until you start dipping into principal. So the reality is there's no different. It's no different in your retirement years than when you were working. You can't spend everything you make, even when you're focused on fixed income. And that's why we have generally the rule of 3.5% or 4%. If you're in your 60s, you probably can't afford to spend more than maybe 3.5% or so. And the older you get, the more amount you can take, because the shorter your life expectancy. Once you get in your 70s, and we're very comfortable getting 4%. And why 4%? When we talk about 4%, what I'm talking about is withdrawing 4% a year. If you're getting, 5 or 6% a year on your portfolio from income, and you're withdrawing 4% from your portfolio, well, what that means then is you've got 1 or 2% that you can start tapping into before you ever get into principal. So there's room to adjust for inflation, and it's twofold. One is that you could increase your income and still never exceed your interest and dividends because you're taking less income than you're earning. But the second is that every year you're taking 4%. If you're earning 6%, then all that earnings is getting reinvested despite what you're taking. That's an inflation hedge as well too. If you want to add a third component, most of you have some percentage of your portfolio in stock. And that could also act as an inflation adjuster as well. But we got to be really careful, because what if that component drops? That's the wild card. When you're invested for fixed income, the 5-6% after fees, that's not a wild card. We know what that's going to be. But if you're invested for growth, it's a wild card. We don't know what it's going to be. So the questions have to do with inflation. And then over the next 10 or 20 years, purchasing power, again, it goes back to you can't spend everything that you make, just like you couldn't when you were growing up in this world. So let's move on. Hopefully that answers that question. We've got some I've got now a lot of kind of general questions. So these will be kind of one at a time. No surprise there were questions about the war and always questions about inflation. But now we get into more kind of one-offs. But I think one-offs that will help. So here, let me read it a little longer, but let me read it. Maybe this is kind of a basic question, but with everything going on right now, inflation, the market's going up and down, and now the war overseas, how is someone supposed to know if their retirement plan is really on track or not? I guess what I'm asking is, what are the warning signs that the things might not be as secure as we think? That's a heartfelt question. That's a question where someone's worried. Someone is things are going on. Can't control it. How do we know that things aren't going to crash? The true answer is we don't. You don't know what's going to happen. You didn't know in 2000 that the tech crash was going to happen. You didn't know in 2007 that the financial crisis was going to happen. You don't know. The biggest fears today, right now, with no close second, is geopolitics. And geopolitics, that's a fancy word for saying everything that's happening outside of the country, right? That's no secret. And so, that, by the way, that could include tariffs. That's policy. That's politics. I'm surprised I didn't get any questions about tariffs. It almost seems like that's kind of blown over. It still affects prices, but the reality is it's everything that's going on in the Middle East that certainly has an impact on, you know, the greatest possibility of something wrecking our economy or stock market has to do with what's going on in the Middle East. Terrorist attack. You know, that's something that's very real. We haven't had one for a long time. And, you know, people think that, okay, we haven't had one for a while, we can't have one. I think people are a little more on heightened alert today. I know I am, just from everything you hear in the news and so on. And, you know, one terrorist attack, look what happened when 9/11 happened. You know, could we have another 9/11? I think we could. I'm not saying we will. No one knows, right? But we could, and that could cause a stock market. So, you know, the reality is, you know, what are some of the warning signs that things might not be as secure as they think? So geopolitics right now, we have this big warning sign. And I hope in, you know, a month from now, the war's over and everything. And I don't know what's going to happen. But outside of the war and some of the immediate obvious things there, what are some of the other warning signs? Well, the other warning signs is GDP is slowing down. GDP is gross domestic product. It's every time you buy a product or you pay for a service, it adds to GDP, and you want an economy that's growing. GDP was 2.4% last year. That's healthy. That's, you know, between, you know, 2 to 3%. That's healthy GDP. And yet it's predicted to be somewhere around 1.5 to like 1.9 this year. So it's slowing. And the reason it's slowing is because people are spending less. And the reason people are spending less is because the job market is tightened up. And because the United States, 70% of the GDP, gross domestic product, is based on the stock market, as goes the consumer, as goes the country, as goes the economy, as goes the stock market. And it all starts with you spending money, and you spending money all starts with the jobs. And this also ties into inflation. So we're going to tie in as well, too. But a year ago, no, sorry, longer than that, 2 to 3 years ago, when I was doing live TV interviews talking about a lot of this stuff, I specifically remember talking about the tight labor market. And by tight, what I mean is that there were, at the time, I think the highest number that I ever reported was 1.9 jobs available for every, I'm sorry, that's backward, 1.9 workers available for every job. Okay. 1.9 workers for every job. That means, and actually, I'm sorry, I'm confusing myself. I do this on live TV, and now all of a sudden I'm confusing myself. 1.9 jobs for every worker. That's what I mean to say. Sorry. 1.9 jobs for every worker. What that means is that a worker could leave their job, and because there was such a demand for workers, because there were almost twice as many jobs available as there were people working, because of that demand, a worker who didn't like the job could go to another place and get a raise and get a better job. Or a good worker who was working at a company could pretty much command another raise or a higher raise to keep the job that they have if they were any good. I had to give lots of raises over that time to keep the employees that were good. It's very expensive to go out and try to get new employees and train them. It's much better, much easier to pay someone to pay someone to replace someone. It's much easier to pay someone more and keep them, much less expensive in the long run than it is to try to replace them. So 1.9 jobs for every worker. Workers could command more money. Workers could leave. I had to give lots of raises. And that has to be passed on to the consumer. And if it's passed on to the consumer, that means inflation is going to grow. Now, there are some sources of inflation that can go up and down and be flexible, and they'll go up and then they'll go down. Energy is a perfect example, right? Gas prices go up, gas prices go down because it depends on the oil market. Grocery stores, commodities, right? Food goes up, food goes down because commodity prices go up and go down. Those are inflation adjustments that can be made both up and down. So when inflation was at 9.1% in May of 2022, and and then now it's down to 2.5% or so, those prices come down. Wage inflation is not like that. Imagine if I were to go back to my employees and say, "Hey guys, I want to take back the raises I gave you because the labor market is softened." It doesn't work that way. Now, in some sense, it might, Because what's happening right now is because the labor market is softened. Right now, there's only one worker available for every job. Someone asked me, and when I say someone, I mean a live TV interview that I did 2 weeks ago or so. They basically said, the question had to do with, what do you think about this, this labor market and the fact that it's undergoing, what was the word they used? That's abnormal, an abnormal labor market right now. What do you think about it? That the question was along those lines. I said the labor market right now is not abnormal. I said the labor market was abnormal when there were 1.9 jobs available for every worker. That was the abnormality. Not now. Now it's very normalized, but it was abnormal back then. And if you're wondering why were there so many jobs available and so few workers available, it's because of COVID. Right? A lot of people were forced into retirement because they might have been on the brink of retirement anyway. And so COVID pushed them over the edge. There were some people that, two families were working and one wanted to stay home. And there were people that didn't want to get vaccinated. But there were a lot of people that exited the workforce. So it created a shortage of labor. And that's what created this. So that shortage of labor caused companies to have to raise wages. That then increases the price for inflation. That's why inflation today is sticky. It's sticky because of the fact that you can't go back and take away the wages, but a lot of companies are starting to rotate out of those individuals. You see this in the tech industry where basically they're starting to say, okay, we had to give you a raise in the last few years. Now we're going to lay you off and we're going to focus more on AI. And we were overpaying you anyway. So you are starting to see some layoffs, right? We've heard of some big layoffs happening recently. And the reality is that it's probably going to be happening more, but the unemployment rate still 4.3%, so still very, very low. But the labor market is softened. Consumer debt's creeping up. Consumer savings is creeping down, and consumer spending is down, which is why GDP is projected to be about 50% less of what it was last year. Okay, somewhere between 1.5% and 2% or so, depending on who you ask. So the question that we're answering is, what are some of the signs? The signs, the biggest sign to me, and I've been asked this, I was asked this just recently on an interview, and that's, what's the number one thing you look at? By far, to me, labor market. That's the one thing you look at, as goes the consumer, as goes the country, as goes the economy, as goes the stock market. People spend less money. That means there's less corporate revenues. That means there's less corporate profits, and that's not good for the stock market and for quarterly earnings. So that's, I think, the biggest thing. And then we can see the consumer weakening. So hopefully that helps. Move on to the next question. What's this question? Anthony, one thing I've always wondered is how retirees should think about balancing growth versus income in their portfolios. How do you decide how much of a portfolio should still be invested for growth versus focused on generating reliable income? That's a great question. I like that question because many times people think, and this might be my fault, it might be this is the way that I positioned it accidentally, but sometimes people think that if you're invested for income, then you're not invested for growth. Same thing with inflation, right? Or with inflation. We said that earlier that people think that if you're infected, you're not infected. If you're invested for fixed income, then you can't keep pace with inflation. That's a thought that doesn't carry any merit, but it's what they think. Well, same thing here. If you're invested for income, then you can't be invested for growth, right? And that's a thought. It's not true, but it's a general thought. But the reality is that growth can come in the form of interest and dividends or capital appreciation. Capital appreciation is buy low, sell high. Interest and dividends is everything you guys are invested mostly in. That's the interest and dividends from your portfolio. And advisors across the country, because most advisors focus on the accumulation phase of life, they've hijacked the word growth. And they've associated growth with capital appreciation. So when I ask you, how do you grow your portfolio? Well, you're going to invest in things and you want their share price to grow. It's all about growth. It's all about capital appreciation, buy low, sell high. And that's because most advisors specialize in that. That's what we tend to think as synonymous with growth. But you don't have to buy low and sell high to grow your portfolio. You can reinvest. You can invest for interest and dividends much more conservatively and reinvest your interest and dividends. And yeah, you're not going to make probably as much, but you don't have the potential to lose as much, but you're still growing your portfolio. It's just when you're focused on capital appreciation, it's a complete random wild guess because you have no idea what the market's going to be worth in a year or 2 or 3. It's a guess. But when you're focused on interest and dividends, at least you're getting paid some interest and dividends while you're waiting. And if the market goes down and you've got interest and dividends coming in, you're getting paid to wait. But if you're focused on capital appreciation, you're not. You're losing buying power as long as the market is underwater. So growth is not synonymous with capital appreciation. You can also grow your portfolio through interest and dividends as well. So then the question is, well, how do we decide how much should I affect, for growth or for income? I think it's a great question. This really becomes very specific to your situation. So let me give you some generalities. First of all, if you're fortunate enough to be in a situation where you don't need the income, and that'd be one extreme, right? You don't need the income. You've got pension, rental income, low expenses. You've done well. You don't need anything from your portfolio at all. Heck, you could be almost as aggressive as you want, really. You don't need the income. Now, you got to be careful. Just because you don't need the income now doesn't mean you won't need it in 10 years. Doesn't mean you won't have a long-term care event that could wipe you out, or that you'll need the income. And if you don't need the income now and the market crashes and you lose your shirt and you're like, I don't care, I don't need it, and then you have a stroke or you need long-term care and all of a sudden you need the income, that's not a good place to be. Okay, so we don't want to think that just because I don't need the income that you shouldn't be thinking about that you might need it in the future. Just because you don't need it now, it doesn't mean you're not going to need it. But if you don't need the income now, it certainly allows more flexibility for you to be invested for growth. That's one extreme, no income needed. The next extreme, on the other side, is you need every penny you can get. Well, in that situation, you might want to focus every dollar you have on creating income because now you need all the income you can get. Most of you are not in either of those situations. Most of you need some. And it depends on what you need. If you need some income, then we have many of you set up in a situation where you've got this chunk of your portfolio generating you the income you need, and this one's designed for growth. This one can ride the ups and downs. This one can ride the volatility. Why? Because you've got your income positioned over here. So it all depends on your situation. So I can't say that it's half-half. Some of you it is half-half, but what I would suggest is get your income in a row. Get part of your portfolio set aside to give you income, and then that allows you to be a little more aggressive as you want with the rest of your portfolio. Now, I will also say that we do have a lot of clients that have a sizable portfolio that don't need the income, but they want the income. And if they're honest with themselves, as a lot of them have been, they'd love to get some money out of their portfolio to go do some of the things that maybe they normally wouldn't do. On their current income budget without their portfolio, maybe they wouldn't fly first class. Maybe they wouldn't stay at 5-star hotels. Maybe they wouldn't do some of the things that they want to do. Maybe they only take 1 trip a year, not 2. But if they can get income out of their portfolio and know that it's true income, they're not cannibalizing their principal, they're getting interest and dividends. Now what they can do is increase their lifestyle and do some of the fun things that they want to do. So if you're in a situation where you're saying, yeah, Anthony, I've done great, I don't need any money from my portfolio, I don't need income, I'm just going to let it sit, then I'm going to challenge you and say, well, what is it that you're not doing in retirement that you could be doing? What could you be doing better in retirement? Because isn't that what you worked hard for? Did you really work hard, sacrifice along the way, decide the cars and the trips that you take so you could put money away and keep putting money in your 401k so you build up a big pile to just die? Is that really what you did it for? I'm going to say no. You probably did it so you can enjoy retirement. So for those of you in that situation that don't need the money, take some anyway. Go just enjoy yourself. Have fun. That's why you worked hard. So hopefully that answers the question about, how do you decide how much of a portfolio should still be invested for growth versus income? Make sure you get your income taken care of, and then you can focus on growth for the rest of it. And even if you have a large portfolio, you don't need income. We have a lot of clients in that situation that even if they don't want to spend it, they still love the idea of just getting 5-6% a year consistently. They don't have to watch the gyrations in the market. They don't have to watch the portfolio. They could afford to, but the heartburn factor for them is too great. They just don't want to, and a lot of you are in that situation. few more questions left. How much time do we have? Oh my gosh, 45 minutes went by just like that. A lot of these I think are easier questions though. So should I have a plan to start converting portions of my IRA to a Roth? And then she or he, I don't know who wrote this question, put in parentheses, of course, over and above my RMD. And then there's another comment that says, my brother is religiously doing that on a 10-year plan. So I could take an hour and just talk about this. I'm going to give you the short version. When you convert from an IRA to a Roth, what you're doing is you're converting some money from an account that you've never paid taxes on to an account that you will never have to pay taxes on. And in that conversion process, you have to then pay the tax. And the reason that you have to pay the tax, or I should say, the fact that you have to pay the tax is what keeps people from doing conversions. You got to pay the tax. And most people would rather delay the tax as long as they can, and then have to deal with it later. And that's what's going to wind up happening. So I'm a big fan of paying the tax now and doing a conversion now, because anything that you pay the tax on now that gets converted, well, whatever amount is converted is going to grow tax-free forever. It's not subject to RMDs down the road. And you mentioned something that you have RMDs. So whatever's converted is not subject to RMDs down the road. So it gives you the ability to control your tax bracket. And by the way, taxes are on sale. The Trump Tax Cuts and Jobs Act is still in force for probably the rest of its term. And that means that you'll save on taxes when you do the conversion. So I think if you're thinking about doing conversions, it makes a lot of sense to do the conversions. And I think now's a good time. And it's not all or nothing. You mentioned your brother's been religious in doing this for 10 years. I think that's a great strategy. It's not all or nothing. And it's not all at once. If you have a certain amount in your retirement plan, most of the times it doesn't make sense to convert everything. A lot of times it only makes sense to convert half of what you have. So if you have $1 million, it probably only makes sense to convert $500,000. And then if you take that $500,000 and you divide it by 10, you push yourself on a 10-year conversion plan, depending on how old you are and so on, you might convert $50,000 a year for 10 years. And the taxes are going to be painless. And it's not going to be that big of a deal. And then you put it into a Roth IRA, and now it grows tax-free forever. So I think your brother's doing it right. I think this is a long-term strategy. It's a short-term pain, right? You got to pay the tax now for a long-term gain. So I think your brother's on the right track. And so for you, should you plan to start converting portions of your IRA? I mean, I don't know a lot about you. I don't know who asked the question. I think generally I'm in favor of Roth conversions, and yet there are exceptions. Feel free to get that answer. Feel free to call Tuan, and he'll run through the numbers with you and see if it makes sense. What else? There are ads. Next question. There are ads about locking in guaranteed 10% return for 5 years. Are there hidden catches, or are we missing out by investing for a more modest return? So let me answer the question. There's no such thing as guaranteed 10% for 5 years. It doesn't exist. So it's not guaranteed. It may be promoted like that, but there's always going to be some kind of a catch. Now, the question is very generic. So I have to think about, what could be offering 10%? There are some private real estate investment trusts where you tie up your money, it's completely illiquid, you have no access to it, that might be giving you 10%, but usually these are properties that are distressed. These are properties that have problem. A solid real estate investment trust that's not going to have those issues is only going to pay you maybe 5 or 6%. They are not paying you 10% out of the goodness of their hearts. They're paying you 10% because people know what the risks are. Maybe everyone knows what the risks are, but you. And that's why you're asking the question. So it's one thing. And there are other things like this, limited partnerships that will offer 10%, but there's risk. They're not offering 10% without risk. So yeah, there are definitely some catches and some trade-offs. Now, there's another thing that immediately popped in mind when I read this question, and that is there are annuities out there that will grow your income by a certain percentage every year. And the annuity companies will do some advertising, or really, it's not the annuity companies. They're not the ones advertising. It's the agents that will do the advertising, and they'll promote it and advertise it as a 10% guaranteed growth a year, but it might be 10% guaranteed growth a year of your income. It is absolutely 100% no way guaranteed growth of your value. So it doesn't exist, and where it does exist, where someone is promoting 10%, the word guaranteed can't be used, and there's going to be a lot of risk and certainly going to be a lot of catches. So as well, we have some of you have BDCs in your portfolio that we've invested for you that are paying 10%. Not a lot of them. Why? Because there's risk. But a small percentage of them might be paying 10%. So I'm not saying that you can't get 10% on some things. What I am saying though is that it's not guaranteed without risk, and that's kind of what the question is implying. So. What else? Looks like we got 3 more questions here. Dividend stocks. What dividend stocks do you see in the future worth investing now? I have no idea. Then it becomes a crystal ball. That goes back to crystal ball question, right? So what stock's going to do? I don't know. Stocks that are on fire now is right. NVIDIA, Oracle's on fire now. Some of the computer chips, but does that mean that they're going to continue to be on fire? I don't know. What I do know is that, Sound Income Strategies, kind of our investment arm that helps us invest your portfolios, they have done a ton of research and have somewhere between 40 and 50 value dividend stocks in their portfolio that are all yielding 3, 4, 5, 6%, in that range. And these are value stocks, and they're all paying dividends. And what they're looking for is they're looking for companies that have paid dividends for years at a time. Right now, when you look at the S&P 500, over 10% of the S&P 500 these companies have not only paid dividends for 25 years or more, but they've actually raised dividends every year for more than 25 years. So a company, when a company pays a dividend, they decide on a quarterly basis whether or not to do that. There's no promises. So you have to look at the historical track record. And what we're looking for is companies that we think are going to keep paying the dividends. We're also looking for companies that are going to most likely keep increasing the dividends. And we're looking for companies that the market seems to be undervaluing what they're actually worth. And this is very difficult to find. But we're looking for companies that seem to be undervalued for one reason or another, out of favor, but are fundamentally solid, because a lot of times these companies over time will tend to rise in value, but they're not the fluffy, frothy growth stock like the Amazons or the Google, because those could go the other way. These are more value stocks, companies that are undervalued but been around for a long, long time, that pay you dividends. So again, you're getting paid to wait. So Eric Byrich is one of the co-chief investment officers at Sound Income Strategies. It's his job to find these companies and to be actively upgrading or downgrading or changing them and moving them. So he's not trying to trade them, but things happen. Things are different today than they were a month or 2 months ago. So investments that, stocks that we might have put in your portfolio 2 months ago are going to be different than stocks that go into your portfolio today. Just because things have changed. So I can't recommend just one, but he's got 40 or 50 that he thinks are good. And he's been a value investor for decades. I think we're over 3 decades at this point. He's done extremely well and really just enjoys doing it. What else? How badly is the current stock market volatility affecting our savings performance? So the reality is that I'm not sure how to take that. Well, I guess the market volatility, if you're invested for income like we talked about, then market volatility is not going to have an impact. If people panic when COVID happened, and even some of the wars, some of the portfolios bounced around. I don't think our portfolios bounced around a lot in the war situation, just in the last couple, but in COVID they did. But if you were getting your income, you didn't miss a beat. And if you were reinvesting your income, then the fact that they dropped because people were panicking actually helped you. And it was very short-lived because people came to their senses very quickly. But the reality is what's going on in the market right now, if you're investing for income, should not be affecting your income at all. And that's what I want for you. I don't want your income to be tied to whether someone blows up someone else in another country somewhere that's not here. I don't want your income to be, it doesn't need to be. Go live your retirement and have the peace of mind of knowing you're going to get the income no matter what. That's what we focus on here at Providence Financial. What else? Next question. How much money lump sum to put in today in retirement fund to generate $5,000 a month income without ever losing principal? So you take $5,000 a month, that's $60,000 a year. You divide it by 4%. That comes out to be what, $1.5 million? So $1.5 million should generate you about $60,000 a year. Yeah, that's about right. Million, and so that's how you come up with that number. But why do I come up with $1.5 million? If you follow the rule of 4%, and by the way, little sidetrack. I talk against the rule of 4%. If you're invested for growth, they say you can take 4% a year out of your portfolio and not have to worry about running out of money, but that's not true. Numbers have shown that that's not true. But if you invest for income, then you can take 4% because you're earning 5 or 6. So if you follow our rule of 4% and you're taking 4% a year out of your portfolio, $1.5 million on 4%, $60,000 a year. So that's how much. If you want to get $5,000 a month, you need about $1.5 million at the rule of at 5%. Now, if you're 80 years old, and you might only have another 10 years or so, if that's kind of the way your health leads you to think and so on. I want to be careful because a lot of people at 80, very few people at 80 think they're going to make it to 100. But many 80-year-olds are going to make it to 100. So you want to be careful not to plan you're going to die at 90 and then you don't. But if you're not in great health and some of the issues that kind of lean odds, and you want to get more out of your portfolio, then maybe you can get 5 or 6% a year out of your portfolio. So if you have $1.2 million and you're earning 5%, that's $60,000 a year. 1.2 million. So 6% of $1 million is $60,000 a year. So you can certainly take a little bit more the older you get. So hopefully that answers your question. And that was really our last question. So I certainly hope it helped. But I want to throw one more thing out there. And that is, I want to remind you of the Providence Premier Club, which is something that I announced at our client appreciation event back in November, where we had the casino theme up at the Universal Sheraton. And what I did is I let you know that we are super thankful for your referrals. And I know that from talking with you and doing reviews with you and having conversations with you and being in touch with you, I know that many of you have the peace of mind. As a matter of fact, I'm going to say all of you now have a peace of mind that you didn't have before because you're focused on interest and dividends and conservative investments. And a lot of you have told me that before you met Providence Financial, you were worried. You were concerned about risk. You were concerned about volatility. You were concerned about whether or not you could get income for the rest of your life. How much income can you get? You had questions about your retirement. This is, the people who come to us who are attracted to Providence, those are the concerns that they have. Well, the fact is that most of you don't talk about money with your friends. So it's very likely that they have some of the same concerns that you had, but it's just hidden. And we get a lot of unsolicited referrals each year, but we've never asked for them. And we're not asking for them so much for Providence, although certainly it helps. But people that are concerned about retirement like you were, that I think over the course of the next few years have potential to have their retirements affected in a big way. We knew people in 2007 that wanted to retire in 2009 and couldn't. I think we have another scenario like that coming. The market's not going to go up forever. We're going to have some problems. And what the Providence Premier Club does is it simply is a way to thank you for referring the people you care enough about to Providence, so we can help them feel the same way that you feel as a result of working with Providence. That's it. It's just a thank you for that. So we created this Providence Premier Club. And if you refer someone to us and that person is retired or close to retirement and they have a phone call with one of our advisors, that's it. One phone call, kind of an intro call, usually 20 or 30 minutes with one of our advisors. Just for that, you qualify. If they're close to retirement or retired and they have a call with one of our advisors, you qualify. They don't have to become a client. They just have to have some curiosity in what we do and be willing to speak with one of our advisors. And that's it. You qualify. And what you get when you qualify is you get two things. You get a box. This is not in Amazon box, cardboard with the swishy face. That's not, no. This is a custom branded box that when you open it up, what you're going to see, well, That's part of the surprise. I will let you see what you're going to see. But let's just say people that have seen it have been shocked. They're like, oh my God, I can't believe they want to keep this box and the goodies that are in it. So you're going to get this box generally after you qualify, after we talk to someone that you've referred to us who you want to help. You get the box about a week later. You're going to enjoy it. The second thing you get is you get invited to a Providence Premier Club only event. We're trying to keep it small. We don't want it to be big. I want it generally to be between 20 and 30 people. The last one we did, the first one we did was just a week ago. We did it at the Perch. It's an upscale restaurant in Los Angeles, and I didn't want to drive to LA. We knew you wouldn't want to drive to LA, so we all met at the office at 4:30. We took a nice shuttle van to the Perch. I had such a fun time in the shuttle van, all the clients together. We went up, we rented out the entire floor there. We had private dining with all of us. There were 22 of us. Private dining. We had a magician come in and do a private magic show. The guy was good. I don't know. For some of you on here, I'm sure we're there. And it was fun. It was only for Providence Premier Club members. So the bottom line is you get invited to that. We're going to do like one every 6 months. So we're going to do a couple a year. The next one's going to be slated for July. And the qualification period now is from January 1st to June 30th. I think June only has 30 days. So the first 6 months of the year, that's a qualification. And all we have to do is talk to someone who you think we can help feel as good as you do about working with Providence. That's it. So wanted to remind you of that. I want to invite all of you to come to the club with us. It's a chance for me to go, for our staff to go. I would love to bring my family. Couldn't go this last time, but I bring my family, my kids. We just go. We have a lot of fun. Just to thank you for being a valued client of Providence Financial and for being willing to stick your neck out and introduce us to someone who we might be able to help feel the same way. So thank you for those of you that are PPC members, and for those of you that want to be a member, feel free to call Tuan. Feel free to call us. Let us know that you have someone you're thinking of, and we'll talk about how to make an introduction. Very easy. If you think they would enjoy my book, give us their information. We'll mail a copy of my book to them. Thank you for joining us for this webinar. We're a little bit over time. I certainly hope it's helped. I'd love your feedback. If you want to shoot me a quick email about what you think we did well in this webinar, just something informal, whether you thought it would help, I'd love to hear from you. Thank you. God bless.